Welcome to our 2024 Platinum Group Metals Yearbook launch and briefing. We've been producing these reports as CPM Group since our inception in 1986-87. And before that, we were producing Platinum Group Metal annual reviews and outlooks at J. Aaron and Company starting in 1981. And then after J. Aaron was acquired by Goldman Sachs, they became the Goldman Sachs Platinum Group Metals Review and Outlooks until we left in 86 to set up CPM Group. So we've been doing this for a long time. In fact, we've been doing it longer than anybody else. And I actually started doing research on Platinum Group Metals in 1979. And brought that research over to J. Aaron when I went to their research department in 1980. I'm going to give you some introductory comments today and then pass the microphone to Rohit Savant. He is our Director of Precious Metals Research, and he is the author of our yearbooks as well as other precious metals reports that we do. Carlos Sanchez and I help out. But he's really the primary producer of these things and the guy who's really on top of these markets. Before I give the microphone to Rohit, I want to thank our sponsors. We have a variety of sponsors. We have a new sponsor this year, Assemblon, which is a company that has a liquid organic hydrogen carrier technology that is superior to the tooling or ammonia-based ones that platinum promoters are promoting. They have different chemicals that have the capacity to carry enough hydrogen on a hydrogenated basis to be useful for motive transportation. And they have catalysts for dehydrogenating their organic carrier that actually would be small enough to fit in a vehicle as opposed to these things that are like 20 foot by 8 foot by 8 foot and weighing a lot. We also have Stillwater Critical Minerals, company, a Vancouver company, TSXV listed, that has some very interesting properties in Stillwater, adjacent to the Stillwater mines. Kitco Metals, I think everybody knows, Corlin Economics Report, a long-time sober presenter of information on global economy and precious metals markets. Noah Capital Markets is an institutional investor in a broker in South Africa that we have worked with since its inception in 2004. The Institute of Scrap Recycling Industries, which is a U.S. organization of scrap recyclers. We've worked with them since the 1970s, late 70s, early 80s. Sabin Metal Group, a major refiner of Platinum Group metals as well as silver. Again, company we've worked with since the 1980s, and Monex Precious Metals, again, a company that we worked with since the 1980s. That is one of the major providers on a retail basis of gold, silver, platinum, and palladium to retail investors in the United States. The Platinum Group Metals Yearbook is translated into Chinese and distributed by the China Gold Association in collaboration with China National Gold Group and Beijing Yuqing Technology. So they will take our report, translate it into Chinese, and distribute it once it's translated. We thank all of these sponsors because they help subsidize the research program that CPM Group has undertaken since 1980, when we were still J. Aaron. A very expensive process to gather data on these very secretive markets that are burdened with a lot of misinformation. In addition to the sponsors, we have media partners, Glacier, Kitco, Metals Daily, Minera Andina, Proactive Investors, and Prospector News. They help distribute our research and information, including these reports. And then distributors that are not media partners but work with us. CGS Events, Gold Block, Gold Silver Central in Singapore, Interact, Prospector News, Southeast Asia Consulting, the David Lind Report, and Fortel in India. So We have a global network of sponsors, partners, media partners, and distributors. With that, I'm going to pass the baton over to Rohit. You'll have to excuse me while I figure out how to do this again. It should be there, but it's not. Kind of disappeared. There it goes. I will pass this over to Rohit and let him get into the nitty-gritty of platinum, palladium, and rhodium. And I'll come back and talk about minor precious metals, and then we'll open it up for questions and answers. Rohit, it's yours.
Thank you, Jeff. So I'm going to start here with platinum. So what you're looking at here is platinum prices, and platinum prices have essentially been moving around the $1,000 level since 2015. The average price of platinum in 2023 was $971, which was an increase of about 1.2% over 2022's level. The platinum price has been stuck around this $1,000 level for nearly a decade, and this is because fabrication demand has not been strong enough to absorb the supply coming into the market. Platinum fabrication demand was hurt initially due to the removal of platinum from gasoline autocatalysts and because of the shrinking market share of diesel passenger vehicles. The second factor still is a negative for platinum fabrication demand. More recently, platinum was reintroduced into gasoline autocatalysts, which has been supportive of demand. But this positive factor is now being offset by the increased market share of battery electric vehicles or BEVs. On the supply side, platinum supply has been declining. But despite this weakness, there's more supply in the market than can be absorbed by the fabricators, which has been weighing on prices and which is what we've been seeing over the past several years. So total platinum supply, which is made up of mine supply and scrap supply, rose during 2023 by around 2% to 6.8 million ounces. Now, despite this increase, total supply was lower than levels seen in 2021 and was part of a long-term decline in total supply that's been in place since 2006. The weakness that we've seen in total supply since 2006 has been the result of a decline in scrap supply as well as mine supply across all regions. The only exception to this has been mine supply from Zimbabwe. Total supply during 2023 was supported by an ongoing increase in both mine production as well as secondary supply. During 2023, mine supply stood at 5.65 million ounces, which was up from around 5.5 million ounces in 2022. You had growth across mining regions, but in many cases, this was growth from a low base. Total scrap supply rose marginally during 2023. The normalization of the global auto market following the chip shortage of 2022 helped offset to some degree the reduced content of platinum from catalysts. So what we've been seeing is that a lot of catalysts that have been coming into the market in recent years contain much lower volumes of platinum, and this is because platinum was done away with in gasoline autocatalysts several years ago. So you did see the recovery in the global auto market last year and the reduced demand for used cars as being something that helped to offset that reduced amount of platinum in gasoline autocatalysts. Total supply is projected to decline in 2024, driven by lower mine supply as well as scrap supply. Both South African as well as Russian mine supply is forecast to decline in 2024, offsetting any strength in other regions. Scrap supply too is projected to weaken as the boost from that normalization that we saw in 2023 fades away this year. So what you're looking at here is South African capital expenditure on the platinum mining industry, in the platinum mining industry. So total South African capital expenditure in the PGM mining industry rose to a record high level in rand terms last year. There are a few things to take into consideration here. For one, much of that capex was stay-in-business expenditure versus project capex. And in light of weak PGM prices, South African mining companies have announced a pullback in spending. So these capex levels that we saw last year are likely to plateau this year or even decline during 2024. And finally, a lot of the growth in South African rand mining capex can be attributed to the weakness in the rand. When you look at the dollar spending in 2023, it was still lower than the levels that it was at in 2012. So one of the many long-term risks that South African mine supply has is a pullback in capital expenditure by these mining companies going forward. The global production-weighted PGM mining cash cost rose for the fifth consecutive year to a record $983 an ounce. And while costs rose last year, they rose at their slowest pace that they have risen at in recent years. Those costs were driven primarily by factors like a shortage of skilled labor in North America and high electricity costs in South Africa. You had generally slowing global inflation coupled with a slight increase in mine production, which helped to keep a cap on costs last year. This year, we still see costs as being an issue. You probably will see cash costs remaining at elevated levels because while inflation has softened, it hasn't softened sufficiently. And a lot of the problems that were contributing to higher costs are very specific to the PGM mining industry. So those are likely to continue to support costs at elevated levels this year as well. So platinum fabrication demand rose in 2023, reaching 6.6 million ounces, which was up nearly 6% from 2022 levels. While this was a healthy growth, it still was this level of demand was still lower than demand that was seen back in 2021. During 2023, platinum fabrication demand was helped by the strength in global vehicle sales. This, coupled with the reintroduction of platinum in gasoline autocatalysts, helped to push total fabrication demand higher. There were factors that acted as headwinds to platinum fabrication demand as well, such as the ongoing decline in passenger vehicle sales and the increase in battery electric vehicles. Platinum jewelry demand rose in 2023, helped by growth in India and the US. Chinese platinum jewelry demand softened last year as relative weakness in China's economic growth coupled with trouble in its real estate market hurt demand for platinum jewelry. Platinum fabrication demand is projected to soften in 2024, slipping around 1% to 6.5 million ounces. While platinum jewelry and electronics demand are forecast to rise this year, weakness in some major commercial vehicle markets, coupled with an ongoing increase in battery electric vehicle markets, is expected to offset the strength in the electronics and jewelry components. So commercial vehicle demand was healthy last year, which played an important role in supporting platinum fabrication demand. That said, the strength in 2023 followed weakness in commercial vehicle markets across the board in 2022 and a generally weak period of commercial vehicle demand since the pandemic. This generally lackluster commercial vehicle demand since the pandemic is one important contributor to soft platinum fabrication demand. During 2024, commercial vehicle demand is expected to soften. Already there is weakness in some markets, and an expected slowdown in global economic growth could cause businesses to further pull back on capital investments during the second half of this year. Diesel passenger vehicle market share has been declining, especially in Europe, where it slid to around 14% in 2023, down from around 56% at its peak in 2011. This trend is expected to continue in the coming years and act as an ongoing headwind to palladium fabrication demand. Another important market for diesel passenger vehicles has been India, where at its peak, diesel accounted for around 52% of market share. This has now stabilized at around 17% over the past 2 to 3 years, with the diesel segment strongly dominated by SUVs. This is somewhat positive for platinum fabrication demand because typically larger vehicles would mean more PGMs being added into the catalyst, holding all other factors constant. So this is Europe's passenger vehicle market share, and a little over half of Europe's passenger vehicle market is now non-internal combustion engines. That is, they are neither pure gas or diesel engines. What can be considered good news for PGM fabrication demand is that much of the balance market share is hybrids and not BEVs. So they have batteries as well as internal combustion engines powering them, and therefore, unlike BEVs, they do require PGMs. The biggest headwind to PGM demand comes from growing market share of battery electric vehicles. These vehicles do not use autocatalysts and therefore require no PGMs. The chart we're looking at here is global BEV market share for passenger light-duty vehicles. The market share for these vehicles stood at around 12% in 2023. There has been a sharp increase in market share of BEVs over the past few years, particularly after the pandemic. Market share for these vehicles has grown from around 2% in 2019 to around 12% in 2023. The pace of growth in BEV market share is expected to slow in the coming years, driven primarily by a slowdown in the West. In Europe, you already are seeing a proclivity towards hybrids over BEVs. And in the US, early adopters have already done much of their buying, and there's limited demand beyond that at this time. A possible change in US policies next year could also dampen demand in the US. Much of the growth in global BEV market share is expected to be driven by China, where already at the end of 2023, BEVs accounted for around 20% of Chinese passenger light-duty vehicle demand. The relative slowdown in global BEV adoption should provide some relief to PGM demand. That said, the trend towards battery electric vehicles is only expected to slow in coming years. It's not expected to reverse or disappear. So one of the primary reasons we saw a reintroduction of platinum in gasoline catalysts was because platinum moved into a persistent discount to palladium in late 2017. And the platinum to palladium ratio dropped to a record low in 2020. While the ratio has been rising since late 2022, until April 2024, platinum was trading at a discount to palladium on a monthly average basis. Over the past 2 months, since May 2024, the platinum to palladium ratio has risen over 1, meaning that on a monthly average basis, platinum is now trading at a premium to palladium. This has raised questions about whether palladium will continue to be substituted with platinum in autocatalysts, gasoline autocatalysts. The reality is that autocatalyst manufacturers are unable to and do not make changes to autocatalyst chemistries on the turn of a dime. There's a lot of money and time required to make these changes and align them with emission regulations and auto engines. So it would take a much higher ratio than what we're seeing right now, and a ratio that remains consistently high for catalyst manufacturers to even consider changing chemistries once again. Additionally, it is probably to the benefit of auto manufacturers to maintain a diversified composition of metals for their catalyst versus tending towards one or the other. So 2023 was the 9th consecutive year that the platinum market was in a surplus. These surpluses have been reflected in the lackluster platinum price that we talked about earlier. If CPM Group's projections materialize, then the platinum market will be in a surplus this year as well. That said, the surpluses have been declining, and they've been declining sharply. In 2023, the surplus in the market dropped to around 216,000 ounces, declining to less than half of what it was in 2022. In 2024, the surplus is projected to fall to around 4,000 ounces or into a nearly balanced market. Despite these sharp declines in platinum surpluses, platinum prices have not risen and have essentially been moving in a sideways fashion at relatively low levels now. This weak price performance can be explained by the massive amount of inventories built up over the past nearly decade and investor reluctance to add metal aggressively to their holdings due to risk of lost demand from the auto sector to growing BEV market share. So what we're looking at here is the cumulative platinum inventories over the years, which have been rising to fresh record levels every year since 2019. When these inventories are not being sold, they have no direct impact on prices. However, their existence can deter new investors who may fear liquidation from previous investors looking to either lock in profits if prices rise or stop losses if prices fall. These inventories can become a bigger headwind when supply-demand fundamentals are not particularly strong, as has been the case for platinum in the past few years. Platinum ETF holdings declined during 2023, which was the third consecutive year of net declines. That said, the rate of declines have slowed in 2023 compared to the previous 2 years. During the first 6 months of 2024, these investors were solid buyers of the metal. These investors have been seeing buying when prices fall and pulling back when prices rise. This tells us that these investors do not necessarily see too much downside from here, but are still nervous about chasing platinum prices higher. So with that, we move on to palladium. Now, while the palladium price has declined, it is still a lot higher than where it was a decade ago. But it has given back a lot of its strength over the past couple of years. In 2023 alone, palladium prices declined by around 36% on an annual average basis. The fabrication demand fundamentals for palladium have weakened substantially, and there does not seem to be much relief from this in the medium term. Supply has also been declining, but the fall has not been sufficient to compensate for the loss in fabrication demand. So total palladium supply has been in a declining trend since around 2019 when it hit a record high level. While total palladium supply rose in 2023, the declining trend in this metric was still intact. Total palladium supply stood at 9.1 million ounces in 2023, up marginally around 0.4% over 2022 levels. The gains in total supply were driven entirely by scrap supply, with mine supply declining during the year. Scrap supply rose during 2023 for two reasons. The normalization of the auto industry, which reduced the demand for used cars and increased the availability of catalysts. And secondly, that the catalysts that are returning to the market now contain a larger amount of palladium due to the removal of platinum from gasoline engine catalysts several years ago. Mine supply during 2023 was dragged lower primarily due to Russia, where due to reduced mine ore in the second and third quarters of last year and because of a change in the processed ore ratio favoring platinum over palladium, total palladium mine supply declined in 2023. Total palladium supply is projected to decline during 2024, driven lower by mine supply, And while scrap supply is projected to rise, its growth is not sufficient to offset weakness in mine supply. Total palladium supply is projected to fall around 4% to 8.9 million ounces in 2024. Palladium fabrication demand has been stuck in a low gear since 2020. The two primary headwinds to palladium demand are the substitution of palladium with platinum in gasoline vehicle catalysts and the ongoing increase in BEV market share. The passenger vehicle market is the most important source of palladium fabrication demand, and the growth in BEV market share is expected to be a major headwind for palladium fabrication demand because of BEV's penetration in the passenger vehicle market. During 2023, palladium fabrication demand reached 9.2 million ounces, up around 5% from 2022. This gain was driven primarily by strength in the passenger vehicle sales. During 2024, fabrication demand is projected to soften, slipping to 9.1 million ounces, down around 1.5%. After a couple of years of weakness, palladium demand from the electronics sector is expected to rise in 2024. However, weakness in passenger vehicle sales, coupled with an ongoing increase in BEV market share, especially in China, is expected to pull palladium fabrication demand lower in 2024. So what we are looking at here is global passenger light duty vehicle sales. The chart on the left-hand side shows sales of such vehicles in developed markets. And as you can see, they rose pretty strongly in 2023, but they're expected to soften a little bit in 2024, which is expected to act as that headwind to palladium fabrication demand. On the right-hand side, you have a chart of the same vehicles sold in developing countries, and you can see that sales were strong last year and they're expected to continue growing this year as well. Much of that growth is being driven by India and China. That said, in the case of China, even though you are seeing a substantial increase in vehicle sales, it may not necessarily translate into stronger demand for palladium. And that's primarily because of the ongoing strength in BEV market share in China in particular, and also the government incentivizing the Chinese market to either buy electric vehicles or to buy smaller passenger vehicles, both of which are not supportive of palladium demand. So the BEVs provide no demand to the PGMs, but even the smaller vehicles would mean lesser PGMs being absorbed by each car. So all in all, even though you do see a possibly healthy passenger vehicle market in China this year, that may not necessarily translate into more PGM demand. What you're looking at here is US passenger light duty vehicle sales, and as you can see in 2023 they rose. They were at the strongest level since 2019 last year. This year there's been some relative softness in demand. The one silver lining here with this market is that as you can see on the chart on the right hand side, which is a breakdown of the composition of the US light duty vehicle market, around 80% of it is light trucks. So this demand for larger vehicles in the US is supportive of PGM demand, primarily because holding all other factors constant, a larger vehicle would typically mean more PGMs being consumed. So this chart is the palladium surplus deficit, and the palladium market was nearly balanced during 2023 and is projected to slip into a deficit this year. While this tightening in the palladium market is helping to support palladium prices, prices really have not seen any meaningful or sustained gain from this tightening. As is the case with platinum, the same is true with palladium, where investors and other market participants pull back on making purchases when prices rise and are unwilling to chase prices higher. And the reason for this investor behavior is because they remain concerned about the massive amount of inventories that are built up in the palladium market. But more importantly, they're concerned with the future demand for palladium, given the changes that are happening in the auto market. So this chart shows the cumulative palladium inventories, and it stood at a record 26.2 million ounces in 2023. As mentioned before, inventories do not have any direct price impact unless they're being sold. However, their presence at these high levels at a time when market fundamentals are weak or questionable tend to deter investors from adding to the metal holdings, which then ends up weighing on prices. So with that, we move on to rhodium. Rhodium prices continue to decline in 2023, with the annual average price sliding around 57% last year. You saw both rhodium supply and demand rising last year, but rhodium supply rose more strongly, keeping the rhodium market in a surplus, which weighed on the metal's price. This year, both rhodium supply and demand are expected to contract, but rhodium supply is expected to decline less than demand, and the market is still forecast to remain in a surplus. That said, the surplus in 2024 is expected to be small, which is what we think is one of the factors that is helping to support rhodium prices at current levels, and this is likely to remain the case over the remainder of the year as well. So total rhodium supply rose in 2023 to 977,000 ounces, up 1.6% from 2022 levels. While both mine supply and scrap supply rose during 2023, the gain was primarily driven by the normalization in the auto industry, which helped to boost scrap supply. Total rhodium supply is projected to decline to 936,000 ounces during 2024, down around 4.3% from 2023 levels. While scrap supply is projected to continue rising, a decline in mine supply is expected to lower total rhodium supply during 2024. Healthy demand from the auto sector helped drive rhodium fabrication demand higher during 2023 to 960,000 ounces, which was an increase of almost 9% from 2022 levels. Rhodium demand is forecast to decline this year to 808,000 ounces, down around 3.2% from last year. This weakness is attributed primarily to the expected softening in vehicle demand during this year. The sharp gains that we saw in rhodium prices that we've seen in recent years has had both a short-term as well as a long-term negative impact on rhodium fabrication demand. Various users have either thrifted or substituted rhodium in their applications. And as we've seen in the case of platinum use in electronics, when prices do come back down, they do not necessarily mean that the demand for rhodium would go up. So once this demand is lost to thrifting or substitution in response to the kind of high prices we saw in recent years, the decline in prices do not necessarily mean there would be an increase in rhodium fabrication demand. So this is probably something that is going to remain or have lasting negative impact on rhodium fabrication demand into the long term. With that, I pass this back on to Jeff to talk about the minor PGMs.
Thank you, Rohit. Obviously, that is the bulk of the reports because those are the big three metals of key importance. I'll talk a little bit about minor precious platinum group metals. There are 6 platinum group metals: platinum, palladium, rhodium, ruthenium, iridium, and osmium. Iridium and ruthenium and osmium they're much smaller markets. They're much more specialized markets. There have been applications for them in a variety of industries over the decades, but they tend to be relatively smaller. They are produced as byproducts at most Platinum Group Metals mines, and over several decades, the absence of fabrication demand for these metals led to large inventories to be built up. Starting around 2004 for ruthenium, around 2010 for iridium, you started seeing much larger increases in fabrication demand. There were a number of new applications, electronics, growing crystals, other applications for both of these metals. And that led to periods of sharply higher prices and a drawing down of those inventories. Our view is that those inventories have been drawn down now, in the case of ruthenium, for 2 decades, in the case of iridium for 15 years or so, and they're getting pretty low. As a result, you've seen the prices of iridium and ruthenium rise over the last 8 years or so, 6 to 8 years. And that is going to continue for some time. In the case of ruthenium, you see a spike up there in 2006, 2007. That had to do with the use of ruthenium in hard drives, where you had platinum and then platinum ruthenium applied to the surfaces of the hard drives that can help control the thermal expansion and contraction of the hard drives, which extended the lives of those hard drives and allowed for a doubling and then another doubling or quadrupling of the ability to store data on those hard drives. While many things have moved to solid state storage from hard drives, the reality is that a lot of the internet-based information, which has exploded and continues to grow at very large rates, is stored on hard drives, large hard drives at data centers. And so there still continues to be some. We've seen the prices rise. They got very high in 2022. They came off in 2023, and they continue to decline into 2024 for the case of ruthenium. Ruthenium, by the way, is benefiting to some extent by the fact that its price is significantly lower than iridium, and it can be used in lieu of iridium in some applications. So you've actually seen the demand for ruthenium benefit from the high iridium prices and tight iridium supplies, even though you've seen the price come off and you've seen other ruthenium users looking to either reduce their per unit use of ruthenium or substitute away from it. Iridium's a little bit different. It did not start rising in 2004. It started to rise around 2010, had a little bit of a blow, popped up to $1,000, came back off. And then really over the last 3 or 4 years, you've seen a very sharp increase. That, in our view, reflects A, stronger fabrication demand, but B, a drawing down of those inventories. And as with ruthenium, we think that what you're going to continue to see with ruthenium and iridium is high prices, tight supplies, and a movement to reduce the use of iridium wherever possible. We saw a sharp decline in iridium prices in 2022, and then they recovered somewhat in 2023. They're somewhere around $4,500 an ounce right now. The third minor metal is osmium, and you can see the price is largely unchanged between $350 and $400 an ounce since the late 1980s, 1989, I think specifically. It has very few uses, and there's ample supplies in refined and unrefined metal. There are some people in Europe who are promoting what they call a special form of the osmium. They're charging roughly 10 times as much as an ounce of osmium. They are relying on research that they generate, and they are trying to find, or they have established marketing arms and companies that will sell this metal to investors around the world. It doesn't look real to CPM Group. With non-exchange traded metals, including rhodium, CPM Group cautions investors away from investing in them. And we'll talk about this a little bit more in the question period. We have managed rhodium, ruthenium, and iridium investments over the years for our clients. Some of the largest and most sophisticated and successful hedge funds, commodity trading funds, managers and owners of those hedge funds and commodity trading funds, and a couple of billionaires have used CPM Group not only to provide the research and consulting on these metals, but also to buy, hold, store, and ultimately sell these metals. We insist with our clients that, investor clients, that if they are going to get involved in these metals, we manage the positions for them because they're all very easy to buy and they're all very hard to sell. And if you go back to ruthenium and think about that big spike up, that was a mistake on the part of an industrial user that was buying more inventory than it needed. When it realized it had overbought the metal, it went back into the market to its suppliers and said, we want to sell some of this metal back. And the spread between the bid and the ask was 100%. Price, if you wanted to buy ruthenium briefly at that peak, was $860 an ounce. If you wanted to sell it back to the same people that had just sold it to you, they would pay you $430 for it. These metals are extremely illiquid, very small companies, and a small number of companies involved in them. And you can buy it, but when it comes time to sell, it'll be very problematic. That's the end of our presentation. We'll open it up now for questions. I failed to mention at the beginning that there is a question box on whatever that thing is that GoToWebinar has. There's a section called questions, and you can type in questions. We don't have the capacity today to allow you to speak the questions, unfortunately, but we can do it. We have about 40 questions that have been sent in ahead of time. Well, so we have well over an hour's worth of questions that we can, just trying to figure out how to be able to see those questions on my machine here. Bear with me. I do not want to speak German on this. So, Carlos, if you are able, well, you see what happens if I move this here. I can see the questions. We'll start with one of the questions, and for Rohit, is platinum supply keeping up with demand? You covered that a little bit in the presentation, but you might want to elaborate a bit on it. I don't know.
So at this time, it is. The market has been in a surplus, so there has been sufficient supply for the amount of demand that there is in the market. Going forward, we do see platinum supply to continue declining. It is possible that in the medium term, you might have a situation where the amount of supply coming into the market is less than what is required by the market, but that doesn't seem to be something that would happen in the short term, but more of a medium-term issue. You have scrap supply coming down. It's been in a downward trend for many years now, and that has to do with the reduction or removal of platinum from gasoline autocatalysts several years ago. So that trend will keep downward pressure on scrap supply. And then you have mine production, which is expected to soften, but it has been softening at a relatively slow pace. It's been in a declining trend now since 2006 when it hit a record high. So that is something that will also weigh on total supply. So we do see total supply declining over the medium to long term. Unfortunately for the platinum market, fabrication demand is also softening. So it's a question of which one softens faster. But at least in the short term, it seems like there's enough platinum there.
Okay. There's another question. Sorry. Are the Russians, there are several questions related to Russian supplies. One is, are the Russians holding platinum and palladium prices down by selling copious amounts of these metals, I assume, in order to fund their war? And then there's another one, where is the platinum and palladium supply coming from, if not Russia? If Russia is cut off from trade, shouldn't the prices be rising? There are some other questions about Russia, but those are two to start off with. If you want to deal with them, or you can kick them to me if you want.
So in terms of Russia, you have Russia is an important contributor to palladium more so than platinum mine supply. But South Africa alone accounts for equal amounts of palladium mine supply as does Russia, and then it accounts for a substantially larger portion of platinum mine supply than does Russia. So that's to answer the question about where is platinum and palladium mine supply coming in from if it's not Russia. A lot of it is South Africa. And then you also have smaller amounts coming in from Canada, the US, Zimbabwe, which is actually seeing a increase in PGM mine supply over the past few years. And then the other question about whether Russia is trying to hold down prices by selling these metals, I think that might be a question that, Jeff, you might be able to answer better.
Okay, I think the simple answer is no. And related to that, it's very important to understand, with all of the sanctions and trade restrictions that have been put in place against Russia and parts of Russia and companies and oligarchs within Russia, platinum, palladium, and rhodium have not had any trade restrictions or sanctions placed on them. And that represents perhaps some of the duplicity of Western governments, but it more also represents the fact that Western governments are extremely aware of the fact that auto production and sales is a major part of each of their economies, or most of their economies, and they cannot produce and sell vehicles without platinum, palladium, rhodium to put on those catalysts. No platinum, palladium, rhodium, no catalyst, no vehicle production and sales. Ergo, platinum, palladium, and rhodium have been excluded from sanctions by governments. There have been some restrictions about delivering Russian metal into the London market. That's the London market acting on that, not the governments. So there haven't been reductions in PGMs, nor have there been increases. And what we've seen is pretty much a steady flow of the PGMs. There have been disruptions, as I think Rohit might have mentioned, in production due to the fact that some of the inputs that are needed to produce and refine these metals, mine and refine these metals, have caused issues. And there have also been friction because of trade restrictions and currency restrictions limiting cash flows. But basically, these things have been free. You mentioned that South Africa, and there are several questions about South African production. I'll give you a couple of them right now. One is, why aren't the cuts announced by Anglo Platinum having more of an effect on prices? If you look at cuts at Cobre Panama or other copper mines, they have been much more influential in copper prices. In Platinum Group Metals, you have seen, as you were pointing out, not only a decline last year and this year, but also a long, steady decline in South African production. And it hasn't necessarily been reflected in higher prices. I know the answer, but I'll let you answer that. And then there's a follow-up.
So I think a lot of it has to do with just investors being concerned about what happens to future demand. So while you might be seeing supply coming down, you also have these simultaneous concerns about demand. You have a lot of inventory sitting in the market. So I think these are the two main reasons why you're not necessarily seeing that much of a positive price impact from some of those announced weaknesses in mine supply. That said, mine prices have stabilized over the past year and a half, and they do rise from time to time. So it's not that they have continued to decline. And we have mentioned in many of our reports that the mine supply side has multiple risks, whether it is the deep level mining in South Africa, the labor issues, the electricity issues. There's a lot of risks to mine supply, which can further reduce production. But until and unless something of that nature actually happens, that risk actually materializes, it's probably going to be more of a supportive factor to prices rather than something that helps to push them up strongly.
Yeah. And then following on that very topic, how does CPM Group expect the reduced investment rate in South African PGM mining in recent years to affect prices over the medium and long term?
Well, I think that's definitely something that is positive for PGM prices in the long term, because reduced capital expenditure and spending at this time will have a negative impact on mine supply in the future. We are already seeing some of that as a result of the pullback that we had in the last decade following the sharp run-up in 2008, 2009, when prices had spiked up. So the pullback that we saw in spending over the last decade is having somewhat of a negative impact on mine supply today, and ongoing slowdowns in capital expenditure or project finance is likely to have a long-term negative impact on mine supply and therefore be supportive of prices.
Mm-hmm. Okay. I think that in a world where people tend to see the world black and white, whereas I used to say that, it's 50 shades of gray, but it's a spectrum of gray. And I think one of the things that we're seeing is there was over-enthusiasm as far as CPM Group was viewed about the electric vehicle market and how fast electric vehicles would take market share. And we looked at the capital required to build an electric vehicle industry globally and build electric vehicles. And we looked at the availability of not only raw materials like high purity manganese and high purity cobalt sulfate and things like that, but also the cathode active materials, the controllers, the motors, etc. And we said, the advent of electric vehicles and the growth in market share will be much slower than many people think. Now, this year, we had seen earlier in the year a downturn in electric vehicle sales. And we saw recently a poll of U.S. electric vehicle buyers who own electric vehicles, who 85% said our next vehicle that we buy will be a conventional petroleum-based gasoline internal combustion engine vehicle. But that said, even in the second quarter, we saw an uptick so that EV sales in the United States are now up year over year in the first half of this year, while they were down in the first quarter. So people saw that decline and they said, oh, the electric vehicles are a flash in the pan. It's going to be a failure. There's a decline in the EV market. And you've gone from over optimism to perhaps over pessimism. That as a prelude, I'll ask you if you want to talk about some of these questions, Rohit. Will the decline in the EV market and forthcoming tighter emission targets help to spur demand for platinum, palladium, and rhodium? And then there are some other ones there. But I'll let you deal with that one first.
So, I mean, I don't think we see a decline in EV sales, just a slowing compared to what we've seen in the past few years. I think a lot of what is happening is there's a slowdown in Western markets for EVs, but as you mentioned, it's not a decline necessarily, it's just a slowdown. And on the other hand, you have China, which is aggressively trying to expand market share for EVs. And that matters because at the end of last year, they accounted for EVs accounted for about 20% of their passenger vehicle sales. And they're on track to further increase that market share this year as well by providing incentives and pushing for the sales of these vehicles. So I don't think it declines, but rather the growth slows, which is what we've been saying that would be the case for BEVs. We've been saying that for a few years now in terms of the pace at which market share would rise.
Okay, following on that, there was another question about the slower transition away from fossil fuels, and it had a second portion which was, given the rising affluence in China and in India, how is the longer transition likely to impact platinum demand by the automotive sector? You want to address that?
Yeah, I mean, I think that's essentially the point I was making before, which is you are seeing in China, at least, a pretty aggressive growth in BEVs, and that doesn't seem like it would slow down anytime soon, especially with all the government incentives that you have. India too is seeing some growth, but it's nowhere on the levels that you're seeing in China. And so this slowdown or weakness that people are thinking about or talking about right now in the EV markets is really more in the West. And again, here, it's not necessarily a decline, but more just of a slowdown. So.
Okay. Let me take a couple here. There's one, if we get some type of recession in 2024, won't most PGM stocks get hammered, giving us a much better entry price? CPM Group is a commodities research firm. We are registered and surveilled by the CFTC and the National Futures Association. We are not an SEC registered stock company, so we don't talk publicly about individual stocks. Now, with that in mind, we do obviously pay a tremendous amount of attention to mining companies. And there was this great time in the year 2000 where the CEO at the time of Anglo Platinum complained that not only did we think that we knew more about the platinum market than Anglo Platinum, but we also were saying that we thought we knew more about Anglo Platinum than Anglo Platinum's management did. And in the end, we did. And, they were saying they were going from like 2,000 to 3,600, 3,100 ounces of production a year. And we said, no, they're going to go from 2 to 2.8. And they did. And then they came back down. But, we knew some things that I guess he didn't know about his company. So if there's a recession in 2024, it could negatively affect platinum, palladium, rhodium prices, platinum, palladium, rhodium demand in the auto industry, and equities, South African platinum mining equities. That said, why would you buy those stocks even if they were cheap? That's like saying, hey, Enron's fallen 80%. People think it's going to go bankrupt. I can pick up their stock cheap. No. If you have companies that have not done well, why buy their stocks? Now, there are some mining, PGM mining exploration and development companies that are worthwhile. We mentioned that we have Stillwater Critical Metals as one of our sponsors. That's a very interesting exploration company. In 2000, we had a list of 76 Toronto and Australia and elsewhere listed exploration companies look at PGMs. I'm not sure that any of them have come to fruition. These are lucrative but very treacherous waters to swim in, exploration companies in general, but PGM exploration companies included. There are some real gems. Stillwater, I mentioned, another company we've worked with over the years, Grid Metals, and others. But you have to be very careful. Those are the companies that we would be interested in were we securities-oriented companies. So I think that that's one of the things that you probably want to pay attention to. There's a question, what are the traditional ratios of platinum to gold? Do you want to handle that, Rohit, or do you want me to?
I can let you take that.
I'm sorry, sir?
You can take that question.
Oh, thank you so much. Yeah. Okay. Platinum used to be traditionally at a premium to gold, and it stayed that way for a long period of time. It was a smaller, more specialized market, and gold had various other issues going against it. Platinum has moved to a discount gold over the last several years because investors are interested in gold more than ever before, because they're very much concerned about the economic and political and financial market instabilities that they see globally, nationally, and with their own personal lives. So gold has done very well over the last several years. And platinum is an industrial metal, the primary use of which is auto catalysts, which have been declining for the last several years. So platinum has suffered relative to gold. And our expectation is that that relationship of gold being at a large premium to platinum is probably going to persist for many years to come. It is a reversal of that past ratio, but that's the way things are. Now, while I'm on the subject of ratios, there were several questions about other ratios, and I guess maybe I should talk a little bit about that, because there's some things, we're not big on ratios. We look at the gold-silver ratio, we look at the gold-platinum spread, we look at the platinum-palladium spread and ratio, because other people do. Platinum and palladium makes sense because there's a fundamental substitutability. There's a fundamental reasons for that relationship. Gold and platinum have far more tenuous and gold and silver do too. But there's also this weird thing, and we've seen this. I'm just looking for one of the specific questions. What about the ratio of like platinum to housing and platinum to food and platinum to, other consumer and variables and stuff? And there are people who promote silver, I know, and gold. And they say, well, if you look at the ratio of silver to housing costs or silver to oatmeal, the silver is so cheap relative to oatmeal and housing and food, it's got to rise. But if you look at the ratios historically, there's never been a correlation between these things. And there ought not to be because they're radically different. Platinum is a relatively young, new metal. It was discovered in the 19th century. It started being used in the late 19th century. Its initial uses in the early 20th century were some chemical catalysts, some petroleum refining research going on, and jewelry. It then, in 1973, started being used in auto catalysts, and that became a major thing. That's an industrial metal, and its historic price ratio or relationship with food or housing or anything else has not existed and ought not to exist because it's a radically different thing from those products. So there's this view, I'm looking for ratios, I'm looking for magic numbers so I don't actually have to know about the supply and demand and the fundamentals and the inventories. I can just find some number that allows me to say buy or sell. That's a formula for losing money. So we tend to try to keep people focused on the fundamentals and the macroeconomic environment as it affects the individual metals that we're looking at. There's one other thing that it's like, why doesn't CPM Group start doing research on vanadium? We can't start doing research on vanadium because we've done research on vanadium for more than 20 years. So we do vanadium research, including 10-year projections, supply, demand, and price. We do that on a specialized basis when an individual company, it's not an exchange traded metal. It's not a widely followed metal. But when a exploration company or a mining development company or a mining company or a scrap recovery company or an industrial user or an institutional investor comes to us and says, I'm being, in the case of an institutional investor, I'm being approached by people who want me to invest in a vanadium startup, mining company, pre-development company, exploration company. We will provide them with our research and analysis on vanadium and investment advisory services as to whether or not we think that vanadium makes sense for them and vanadium, that particular vanadium project might make sense for them. So we do that, and we do that not only with vanadium, but tungsten, lithium, magnesium, molybdenum, and high purity manganese, and tantalum, and niobium, and hafnium we do on a regular basis. Uranium, tungsten, and other metals we do on a specialized basis when an individual client comes to us. Now, related to that was a question about whether or not what the impact would be on platinum demand of various technologies, including the vanadium redox batteries. We're still waiting for vanadium redox batteries to really be seen as being something that is a substantially growing market. At this point, they've been a technology like fuel cells that have been a long time coming, but they haven't come. So we're not quite sure that that's a particularly difficult issue. I'll deal with another question while I'm talking. I'm interested in CPM Group take on the view typified by the World Platinum Investment Council that there are huge shortages looming in the platinum market. We don't see that. We have, if you look at it, there are people who do research on precious metals, like CPM Group. And we've been doing it, as I said, since the late 1970s. We came up with the first supply-demand estimates on a global basis in the late 1970s for platinum, palladium, rhodium, ruthenium, iridium, and osmium. And there are people who promote precious metals investments. We don't necessarily promote precious metals investors. We advise investors as to whether or not we think a particular investment makes sense at any given time. But promotional groups starting in the mid 1990s started adding investment demand, the fabrication demand in their supply demand balances. And it was a conscious decision to try to show investors that the silver market and then the gold market and then the platinum market later were much tighter than the research people said, and that there were, in some cases, deficits. That's a marketing thing. It's not a research thing. Commodities Research 101 is that you look at total supply, mine production, as well as scrap recovery, as well as anything else, less fabrication demand. That gives you your surplus or deficit. If you have a market that's in deficit of newly refined metal entering the market relative to fabrication demand, that's a bullish analysis. If you have a market that's in a deficit because you've added a dummy variable for investment demand, which is often way too high, then that's not necessarily that bullish of an investment thesis for an investor. So we do Commodities Research 101, and we see, for example, where I showed you the chart, in the period going back to 1976, which is how far back our data goes, 7 years we saw platinum deficits. Yeah, we don't see very large extended deficits historically, and we don't necessarily see large deficits going forward in the future. So that's our view on that. Rohit, there's a question, the impact of hybrid vehicle demand on platinum. You touched it a little bit, I think, in your presentation. Do you want to talk more about it?
Yeah, sure. So hybrids are a positive for PGM demand, and one market where we've been seeing a increasing demand for hybrids, especially when there's a move away from pure internal combustion engines, is Europe, where they've been moving away from gasoline and diesel engines, and instead of moving only into BEVs, there's actually been a bigger move into hybrids. So demand for hybrids is supportive for PGM demand, because like regular internal combustion engines, they also require catalysts, and in some cases, sometimes they require a little bit more PGM because of the lower temperatures at which these engines tend to operate. So it is a positive for PGM demand.
Yeah, there was another question, given what you just said, slowdown in the EV revolution, more hybrid vehicles being built. Is this a case for platinum, palladium, rhodium use in increase in catalytic converters? And do you see this as a higher probability event? We have, I'll let you address it in a second, Rohit, but I wanted to just sort of say, in our basic research, we follow the International Energy Agency, which again, it's a research company, not a promotional entity. And the IEA and CPM Group and others all agree that if you go out a quarter of a century to 2050, petroleum will still be the major source of energy for humankind. So we see an ongoing use, at least for a quarter century, of petroleum, not only in internal combustion engines and diesel vehicles and gasoline vehicles, but in other places too. So, we start from the premise that these things are there. We may have peaked in terms of how the last 50 years were an issue of the growing demand for platinum group metals in auto catalysts, and the next 50 years may be, the scene may be declining use of these metals, but they're not going away in the next 5 years. Rohit, did you want to add to that?
Yeah, I mean, I think that pretty much sums up our CPM's thinking on this topic, that, you know, we don't necessarily see the demand for these metals disappearing, just declining slowly. And you do have a lot of headwinds to BEV adoption, at least in the near term, so which I think would continue to be supportive of PGM demand.
Okay, here's one for you. Very interested in hearing what the next 1 to 5 years will bring us for the PGM markets. And I think that there is a focus pretty much on price. You want to talk about where we see the price of platinum, palladium, and rhodium over the next 1 to 5 years, or at least 1 to 2 years?
I mean, over that time frame, we see them moving sideways to a little bit higher from where they are right now. You do, as we mentioned earlier, you know, have the supply side issues, which should continue to support prices. Of course, if you have a recession, which then hurts demand for vehicles, then that's going to change the outlook. But in a moderately growing economic environment with supply side issues, I think you see a sideways to slightly higher prices, but not substantially higher unless you see some kind of a supply side shock, which is somewhat impossible to predict.
Yeah. Okay. I'll take this one. Why are electric vehicles powered by batteries being imposed on us instead of hydrogen cells, which is the most present element in the universe? This would give a big boost to the use of PGMs. Okay, first off, you're talking about hydrogen cells, you're talking hydrogen fuel cells. Hydrogen fuel cells, well, their issue, the first issue is hydrogen. It is very expensive right now. It's very expensive and dangerous to ship, store, and distribute. The state of California is spending more than $2 million per fueling station using compressed hydrogen. They're building the filling stations because no energy company or automotive company will build them. The solution is liquid organic hydrogen carriers, as our sponsor Assemblon is working on. The problem is you have to find liquid organics that can be hydrogenated and dehydrogenated and recycled and reused, that can carry enough hydrogen to be effective and efficient and usable on vehicles. Assemblon has found those molecules. Toluene and ammonia, which are used right now mostly in stationary energy storage for load leveling in Japan and some other countries, only hold like 2 or 3%. Some people can play with it and get it up to 5 or 6%. It's not enough to make it. The carriers would be so expensive, so heavy. You'd have to carry so much liquid, organic, hydrogenated carriers that it doesn't work for mode of transportation. So the key to hydrogen is finding a way to have liquid organic hydrogen carriers. And if you buy the PGM yearbook, there's a page in the front that talks about Assemblon and some of the issues limiting that at this point, and some of the solutions to that. So that's the first thing. Now, second thing is fuel cells. Fuel cells have been the motive power of the future for about 80 years. They are extremely expensive. They have technical issues. It's a new technology. the platinum South African producers have made it a whole thing. If we get fuel cells, if we can get hydrogen cheaply and safely distributed, then we can have fuel cell vehicles that use platinum. The fuel cell industry says, well, the auto industry told us to get rid of the platinum in our fuel cells, and we've engineered 99.5% of the platinum out already, and we can get rid of the remaining 0.5%. So we don't actually need platinum for fuel cells these days. But that's not the real issue, because if you go to the auto industry, they've said, if you can get me cheaply and safely shipped, stored, and distributed hydrogen, I will go to a hydrogen engine. The first internal combustion engine, the proof of concept of an internal combustion engine, was in 1806, and it used hydrogen as a fuel, just to prove that an internal combustion engine worked. You go back to a hydrogen engine today, and Toyota and various other companies have been working on it. BMW has been working on it. Ford's been working on it. Other companies have been working on it. An internal combustion engine that burns, if you will, hydrogen is easier to build than an internal combustion engine that burns petroleum products. It costs about half the price. It has fewer moving parts. It's easier to maintain, lower operating costs, lower maintenance costs. There are some issues with the steel has to be coated because the hydrogen can make the steel brittle. But that's interesting there. There are solutions to that. As I said, auto companies and others are working on this already. That would preclude the use of PGMs, because you would be oxidizing hydrogen, you'd be using oxygen from the air. Hydrogen oxidizes at a lower level than nitrogen, so you don't have to worry about nitric and nitrous oxide being created when you oxidize the hydrogen if you're using ambient atmospheric oxygen. There are a lot of advantages to a hydrogen engine. Fuel cells don't make sense. Yes, hydrogen is the most abundant element in the universe, but there are a lot of issues with shipping, storing it safely and cheaply. If those issues come along, it would be very negative for PGMs. I wanted to talk a little bit, well, let me deal with this other question. Could PGMs be used as weapons by South Africa or Russia? Rohit talked a little bit about that. They could be, but ineffectively. And Russia and South Africa both know that. In addition to which, South Africa has no reason to weaponize platinum. And Rhodium and Russia needs the revenue in the foreign exchange earnings from selling platinum and palladium and rhodium. So highly unlikely that should happen. Related question, not really, is what is your view about the $1 trillion platinum coin as a way to raise the U.S. debt limit? That was always a joke, and you shouldn't take it seriously. And it still is a joke. It's just, let's focus on what's real. Speaking of what's real, and we're winding down here, I want to talk a little bit about minor PGMs. And I'm including rhodium as well as ruthenium, iridium, and osmium. I mentioned earlier, these are non-exchange traded metals. They are very small markets. They are highly specialized. There are not a lot of suppliers. There are not a lot of refiners, and there are not a lot of users. We used to work for an auto company, and we were at a offsite with them once, and they said, "Why do you charge so much for your PGM research, while Peter, who provides us his steel research, charges us, a fraction of what you charge?" I said, "Peter does steel research. He can sell that to tens of thousands of companies around the world. We do PGM research," and this was back in the early 90s. There are like 150 companies that have significant enough financial exposure to PGMs that they need to buy research and price projections and analyses of what's going on a supply, demand, and price basis. These are very small markets. That's platinum and palladium. You get into rhodium and iridium and ruthenium, totally opaque, smaller, no price discovery on an exchange. The price is what somebody tells you it is. These are very much markets that should not be invested in by retail investors or even sophisticated investors. CPM Group's policy, when a client says, I'm interested in ruthenium or iridium or rhodium, our policy is, if you're interested in these metals because you're thinking of investing in a company that produces it or could produce it or uses it, we will supply you research and analysis and price projections. If you're interested in it and you're interested in it because you think you want to invest in the metals, we will only advise you if we can be hired or will be hired as the commodity manager of any position. And that goes back to what I was speaking about earlier. You can find anybody who'll sell you this stuff, just like G. Gordon Liddy used to sell beryllium on late night TV. Never mind the fact that it gave you people rash if they held it. You can find people who will sell you iridium or ruthenium or rhodium or even osmium. But when it comes time to sell it, it's very difficult. And it can be very disruptive of the market. As I said, the world's largest user of ruthenium grossly overestimated how much ruthenium it needed. And then when it went to sell it, it drove the ruthenium price down 50% overnight. So these are very illiquid markets, and they're not suitable for investors. Something that you really need to pay attention to. Now, there was another question that was unrelated to that, but related to selling stuff. What is the best way to sell junk silver coins pre-1964? I don't like to call old silver coins junk. I think that they're good, but you have 40% silver bags, coin bags, and I checked with one of our preferred trading companies this morning, and they were offering 97% of the bullion price. They were offering to buy bullion at $30.78, and they were offering to buy 40% bags at $29.75. So that was a 3% discount. The 90% bags, the pre-1964s, they were willing to pay $30.07, which is 98% of the value. So, use that as a metric and go to a coin dealer and see what you can get. Now, that company, one of our preferred vendors, because we get really good prices from them. You might not get a 3% or 4% or 2% discount, but you shouldn't be getting too much more than that. Okay, we still have quite a few more questions, but I think that we've been on for 90 minutes and people probably want to start thinking about where to go for lunch. So we're going to thank you all for being here, listening to us. We're going to encourage you to buy the PGM Yearbook. You can go to CPM Group store and download it. It's an ebook. The last page is how to take that PDF to a print shop or a Staples and say, I'd like this printed and bound. You can do that. I'm not sure what it costs because, inflation's been so bad these days. Thank you for listening to us. We hope that this was useful. We hope it was valuable. We hope that it helps you improve your investments in PGMs over the years ahead. If you want to talk to us, our email address is info@cpmgroup.com. We can talk about how we can help you further. In the meantime, you can buy our yearbooks, and we'll see you on our YouTube channel twice a week. And we'll see you for our gold, silver, and platinum yearbooks again next year in 2025. Thank you and goodbye.